Hello everyone, welcome to today's US Open live session. It is Tuesday, March 19th. I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. We are, of course, 10 minutes before Wall Street opens, as always. This is a very busy week, mostly because of the central bank blitz that is taking place. We already started with a watershed pivot by the Bank of Japan, and of course, we're going to talk about that and the implication for the Japanese yen, the implications for the currency. And of course, over the next 2 days, we expect the US Fed and the Bank of England. So this is what we're going to focus on today. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and please bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. I'll give you a few more seconds to do that, and then we will proceed. Okay, let's get the ball rolling. As we said, we already had the Bank of Japan. We're in a watershed decision, abandoning its ultra loose policies. So we're going to talk about that and the implication of for the currency pair. We also had the Reserve Bank of Australia today, but nothing really changed. A bit of a less hawkish stance, but no change in terms of rates. And then we're going to talk about the British pound against the US dollar and the Nasdaq, and discuss the monetary policy decisions that are coming up from both the US Fed and the Bank of England, and that is today's main themes. Now let's get right to it with the Bank of Japan, and of course on the left here you can see the core inflation for the Japanese yen, and on the right, the central bank rate. So what the Bank of Japan did today in a watershed decision is it abandoned the unconventional and easing measures it has been implementing since 2016 to combat decades of deflation and spur economic growth following the lost decades, the so-called lost decades. The central bank raised interest rates out of negative territory, as you can see on the right of the chart, to around 0 to 0.1% from minus 0.1 previously. It also scrubbed the yield curve control and discontinued the ETF purchases, with these were the highlights. Of course, the reason for doing that is, as you can see on the left, core inflation has been above the 2% target for nearly 2 years. A recession was avoided recently, and signals from the ongoing wage negotiations in Japan are encouraging, and this is a key factor because policymakers wanted to achieve the 2% inflation target in a stable and sustainable manner, along with wage increases, and thus spare a virtuous wage prices cycle. Now they feel that this is in sight, and that is why they pivoted. And this could have significant implications for the yen and, of course, for the stock market. However, against conventional wisdom, we would say, both the USD JPY and the Nikkei actually rose in the aftermath of the decision. And there are a couple of factors for that sort of counterintuitive, we would say, reaction. One of them, of course, is that markets had come to expect this shift. And the other, of course, is that although the Bank of Japan abandoned these ultra dovish policies, it did not exactly turn hawkish, and it is unlikely to embark on an aggressive tightening cycle, and in fact, it will keep buying bonds broadly at the same amount as before, and expects that accommodative conditions will be maintained for the time being. And now let's go ahead and discuss the USD JPY outlook. And we're on our usual chart, the 4-hour chart. So the pair moves higher and looks again towards the July 1990 high, as you can see on the chart. And this, of course, exactly because of what we discussed. The Bank of Japan is likely to take it slow rather than aggressively tighten policy. However, the pair has failed before ahead of this resistance, and the relative strength index points to extremely overbought conditions, as you can see on the chart on the top, on the bottom part of your screen. Furthermore, the Bank of Japan did pivot, and did that in a year that the Fed is looking to move in the opposite direction and actually start removing monetary restraint. This its US counterpart may have adopted a sort of conservative stance towards such a path, but it still has pointed to rate cuts for this year. So you can see that the policy differential could shift, and this could potentially spark a significant repricing. In any case, we can see a return below the 200 period EMA, which is at around 148.8, and daily close below it would shift bias to the downside. However, you can see that the downside is well protected with a thick rising daily Ichimoku cloud, and of course the February lows at 145.88. Of course, we need to say that we expect the Fed on Wednesday, and this will impact the trajectory of the pair. And let's discuss a little bit about the Fed. The US Central Bank has taken a reserved approach towards easing as inflation shows stickiness. You can see on the left the headline personal consumption expenditures, and you can see how we would say the deceleration has been losing momentum compared to last year for sure. And the economy is strong, and the labor market still relatively sticky. So there is no compelling case for a pivot. The previous projection suggested 90 basis points of cuts this year. You can see on the right where the Fed rates are. And these projections implied 3 cuts. Now, the question is, what will officials put down now? Are they gonna stick to the projections, or are they gonna lower it? Because projecting more hikes seems seems a bit difficult under the current environment. And of course, what will Chair Powell say during the press conference? As we said, we also expect the Bank of England That's on Thursday. It has hinted to peak rates given weak economy and progress on inflation. You can see that progress on the left, but you can also see that inflation is persistent over the last few prints, and as such, the Central Bank of England has more work to do to achieve the 2% target. So, for all intents and purposes, uh, the Bank of England is, it will be hard, let's put it that way, to start uh, cutting rates before the Fed. And that, of course, can support the GBP versus the greenback. And now let's go to that chart and discuss the outlook. You can see that the pair faces pressure today and breaches the 200 period EMA. This creates risk for further losses towards and potentially new 2024 lows towards around 1.25. But it's hard to justify sustained weakness given the current policy differential that we discussed. The Fed already tries to defend the 200 period EMA, and as long as it can do that, buyers is on the upside, and bulls can try for higher highs, currently at 1.2894, but will need help from this week's policy decisions. And let's round things off with the Nasdaq. The tech-heavy index has largely ignored the strong data from the US and the Fed's conservative stance towards hikes, and as such, it can push for new record highs at 18,406. But now the next resistance, the psychological 19K mark, definitely looks distant. It's now on the Fed decision how markets will react